Hello, my name is JP Albano. I am the co-founder and CEO of Significant Lifestyle Communities. In this video, we're going to walk you through a deal that we passed on. And we look at we analyze many deals. We're looking anywhere between 10 and 20 deals per week. On a given week, maybe there's one deal that sort of looks good and would warrant further exploration and more analysis. And then in a given month, we're maybe making one or two offers. We're very particular and picky on what sort of deals we move forward. So I wanted to give you a glimpse of some of the methodologies that we use, the thought process for how we filter through deals and sort of go through them. So this is sort of a over the shoulder look of what we typically look at and how we kind of examine deals. So this is a particular property. It is in Montgomery, Alabama. Significant has an office in Georgia. Alabama is very close to where we are, and Alabama has some. They're number one, a landlord-friendly state. Number two, they're a growth market. Certain markets in Alabama as a state have strong population growth, good job growth going on, and there's a nice affordability aspect of that. And so the types of apartments that we like to purchase, Alabama checks the boxes. So this is a particular deal in Montgomery, Alabama. It's a smaller market called a secondary or tertiary market. By the way, just some more information. So primary markets like a Miami or a New York City, or maybe like a Charlotte, those primary markets, they're very competitive. Also, deals are typically apartment projects are typically more expensive because you're kind of paying the premium there for that. A lot of really great deals could be had in secondary or tertiary markets. So what is a secondary market? Secondary market is something right outside of Miami, for example, or something right outside of New York or Charlotte, right? And then a tertiary market is, as you can imagine, outside of that secondary one, right? And the benefit for us is we're able to really, if it's the right place, the right kind of submarket, you can still, number one, get a great deal, right, from a price standpoint, and number two, still kind of piggyback off the coattails of all the the activity, the economic activity that's going on in that secondary market. So it's not a bad thing, I guess, is the point I'm trying to make here. So this deal is I'm trying not to talk too much smack about the project. I'll just explain, why it wasn't a fit for us. So this is Pine Oaks Apartments. We usually go on. So there's kind of two things that happen. Number one, the broker may or may not, depending on the status of the deal, give us what's called an offering memorandum. And it's a very kind of nice, polished marketing material brochure of the property. It's sort of useless because we don't really go off of a lot of information on there. We really go off of the financial statements, the rent roll, which is a listing out of all the people that live in the apartment, how much they pay for rent and how much when it expires, when their lease expires, and then the trailing 12, the T12. That's the actual financial statement that shows us each month how much income they're collecting, how much expenses they have, and how much profits they have left over. It's called NOI. We have a separate video called How Investors Earn Returns that kind of go into NOI and cap rates and things like that. But for your purposes for this video, just know that the financials are and the rent rolls are really the two most important documents. Everything else is sort of secondary. So this particular deal, it's not very attractive, right? From an apartment complex standpoint, right? This is kind of boring, but boring is okay because, we can fix this. So the lens that we use or I use when we look at these deals is, this is a pretty boring place. Supposedly there is there's an under market rent component, meaning this property's rent, their rent is so low. How low is it? It's so low that they're 100% occupied. And that's sort of a common theme that we see with a lot of operators that are selling properties. They have kind of two mentalities. They either want to keep up with the market, wherever that is, or they're just happy to be under the market and just have 100% occupancy. There's some challenges around that. Sometimes you have some collections issues, things like that. So for us, there's potentially an opportunity here because we like to buy these places that are a little rough on the edges, right? Like this one, and maybe add some landscaping. And depending on the interiors, see if there's any interior photos. There's probably not. No, there isn't. To maybe revamp the interiors, and we'll look at some of the comps. Like this is a nearby property. We'll just check this one out. This is 1170, right? So we see a nice range of 849 to 1170. That's a good swing of prices. So let's just check this one out for a second here as it loads up. Hopefully it loads up in a decent amount of time. All right, while that's loading up, let's walk through some other things that we we examine. So we always do a flood search on properties that we're going to buy. Being in a flood zone isn't the end of the world. Usually, the implications are there's going to be more expensive insurance for it, right? And if there's one thing that's been happening in the last couple of years, it's the price of insurance has skyrocketed. Normally, when we underwrite deals, we expect each year our expenses are going to go up. Some expense, but you account for that and you do a kind of what the property is going to operate at. Well, it's sort of hard to underwrite for insurance if it's going to double in price or go up 50% or 40% year over year. And that's sort of what's been happening in the industry today. So as a result of that implication, insurance becomes so expensive that the only, way you kind of make up for it is a lower purchase price or you have to increase rents. And I know the Fed wants to tamp down on inflation, but the insurance is a big part of what's causing operators like us to have to re-examine, what are we actually charging for rent and how do we cover our expenses? Which again is a nice part about apartment investments is it can keep pace with inflation, right? That's one of the main reasons why apartments are a business that can be inflation resistant because each year or every month when a renewal happens for a lease, we can look at our expenses and say, look, we've got to raise your rent. We were going to do 3%, but it's got to be 5% this year. And then, they have a choice of either taking it or leaving it. Right. But, we're able to adjust that on a very granular level, which for an investment standpoint is just wonderful to be able to kind of keep up with inflation and other things. So this property, we do a flood zone. So this doesn't have a flood area, which is fine. Okay. Next thing we do is we do a crime search. Okay, thank you. And we punch in the address here, and surprise, surprise, there's crime. Now, it's a quick background about crime in an apartment complex. Sometimes the data can be a bit more skewed because you have so many people living in a small geographic area. Right, the density is so high. You're more likely to have kind of common petty crime than you would in a regular neighborhood where you've got a house, a family that lives there, spaced out by another family, spaced out by another family, right? So because you got people stacked on top of each other, you're more likely to have things like burglary, maybe some kind of assault. Um, what is this one? Vandalism that happens. What we don't want to see though is the bullseye here, shooting. You don't want to see shootings, right? This happens. We have experience in repositioning properties where there were shootings. I mean, there was a property we bought in Augusta, Georgia, years ago. There literally was a shooting that happened 2 weeks before closing. We were able to get the seller to help pitch in for a security fence around the property, but it's sort of a fact of life, especially given the sort of housing that we do, which are these older properties. Now, I don't want you to have pictures in your mind that these things are all we're slum lords and these are all really, really ugly looking properties. It's not always the case. We are very sensitive to crime, but we also recognize that part of the reason why there may be crime is because of how it's operated today. And so coming in there with new management and new requirements and just new oversight, you're able to ultimately, weed that out. And what that does for us and you as an investor is it creates an opportunity where if groups were scared away because of crime, it's something we know we can tackle. And maybe it's reflected in the purchase price. So, buying at a lower purchase price because of a problem allows us to create more value and more returns for our investors. So we don't really shy away from that, but just giving you insight into what we see in the marketplace. So there is some crime to be aware of. I will say that sometimes shootings, depending on how recent they are, and this is probably a more recent thing, can create a problem. So if there's a recent shooting within the last year ish or so, it can create problems with the bank, meaning the banks get really skittish with shootings there, rightfully so, and it may be hard to actually get a loan. So, these are all things that we use from a negotiating and bargaining tool with the seller, and also kind of get pre-approval from a lender if they're kind of cool with the story there. So this has some crime there. We'll get into that in a second here. Let's see if this property loaded up here. Okay, so this is a competitive property nearby. Looks pretty good. I'll kind of just share with you some of the things that we look at, we see here. So depending on the marketplace, this is a nice kitchen, right? The market for where the markets are in rent, those leaders might have certain features in their apartments. So for example, they might have newer, maybe white cabinets with this countertop. This is like a linoleum. It's a yeah, it's like a man-made product. It's like a coating on there. Um, Maybe they have white or stainless steel appliances, right? And you sort of each market has their own kind of look and feel. And so the idea is that depending on where the market leader is doing, you want to mimic what they're doing, right? So if our apartment looks like this, and the ones leading the rent have stainless steel appliances and granite countertops and linoleum, sorry, vinyl plank flooring, that's the inspiration that we want to move to. We know if we can make those improvements, make the kitchens look like that, we have a higher likelihood of achieving those market rate rents, which sometimes could be $100 a month, $200 a month, $300 a month. A lot of the apartments we like to buy are really, really meaty with respect to how much rent upside there are. $400, $500, which sound like a lot, and it is. And then when you can achieve that, or even a portion of that, it has a amazing multiplying effect for our investors and for the project. So we kind of look at what's going on in the marketplace, what do they look like, what sort of finishes do we have to match or mirror in order to execute our value added business plan, to get the rent. This has kind of things. That's right. They've done a really good job this, which sometimes you'll see, a lot of properties don't. So this looks pretty nice. So we'll close this and we'll jump back to the community here. So the other thing that we did is we do an analysis. We run a report, and the report really helps give us a deeper insights into the property. Right. I'll walk you through that process and what we kind of is area value. We look for home value in the area. What is the average household price of homes nearby? Because one part, if home value is so low, it's a low barrier for entry. And I'm scrolling through this not because I'm trying to make you impressed with all the data here. I'm just trying to get to the part where there's actual data. If home value is really low, like $80,000, the barrier for entry for a renter to owning a home is not very great. So in other words, like today they can rent, tomorrow they can buy a house. What we really want is we want to have a higher barrier for entry naturally, right? We want to be able to have it so that, maybe home values are in the $200,000 range. And it's sort of a function of rent, right? If rent is a certain dollar amount, we don't want like literally for $10 more, you could own a house. Not that we don't want that, but like from an opportunity standpoint of being able to insulate ourselves from risk, that creates a lot of risk for us. So this is primarily a very low income area where, you have almost 40% of the home values at less than 60 grand a year. Um, so that's one red flag for us. What else can we share with you here? There are, it seems like in this area, there aren't really a lot of smaller bedrooms, one, twos, and threes, which means there might not be a lot of demand for that. So this particular apartment property has a lot of one bedroom, two bedroom apartments, ones and studios. The area is really needing larger properties, right? Larger apartments. So we might have a hard time renting those out. That's the kind of takeaway here. Yeah. So home size is predominantly, this is huge. We don't really usually see this sort of makeup very often. It's sort of interesting when you dig into the demographics of each area, how they vary and things that stand out. There are a lot of single family homes in this market, which is fine. We kind of like that. We prefer to have so this map, this report is for a micro neighborhood. It's not for the entire zip code. It's for a micro neighborhood of the area. And in that micro neighborhood, there aren't a lot of apartment complexes, which is nice because you want people to kind of feel like they're living in a residential neighborhood and not living in like apartment land, right? This is part of Montgomery, Alabama, has a lot of retirees, which isn't bad. Like that could be a great market to rent to because demographically or statistically or trend wise, we know that a lot of young adults and retirees are looking for apartments. Like that's where they want to do. They don't want to own a home anymore. They want to rent. Um, so there is a huge market here. So that would tell us like, who's our clientele? Are we going to be working with retirees? That's fine too. Or, is there a large family friendly contingent? We'll get into that in a second here. Special character about the area. Understand the makeup of the bedrooms in the apartment complex if they're supportive of the area demographics. So, for example, if there are a lot, an extraordinary amount of married families that live in an area, and our apartment complex has only studio apartments, that's going to be hard to rent out because families want more rooms, at least one or two, maybe even more size bedroom apartments. So that's where we kind of validate and do our due diligence in making sure that the asset itself, the apartment itself, has the sort of product that we know will have the demand in that marketplace. This is another important area. I've spoken about diversity of employment, and that's really a big takeaway. What we look for are areas and neighborhoods or cities or markets where there's diversity in the employment base. Um, you know, it, the economy is always on an up and down swing, no matter on whole in the U.S. But in a micro level, in each of the cities, in each of the neighborhoods, there's always some kind of cycle that's going on. Things are kind of peaking and booming or whatever else. We want to make sure that where we're buying these assets, there isn't just one major employer or major industry in that market. So, for example, if healthcare, for argument's sake, was 90% of the area, that's a bad example because healthcare is actually pretty strong. Manufacturing, if manufacturing was the big gorilla in the room, that could be a risk because if something happens where manufacturing softens, that can severely impact the people that live there's ability to pay the rent, right? And so we want to see some diversity. Usually, what we look for is at least three or four sort of similar in size ranked industries. Healthcare is always a good one because people are always getting sick, and if things keep continuing, they keep getting sicker. So there's sort of always business for that, and that one is pretty good. Public service is usually pretty good, but could be a problem if there's like a debt ceiling sort of problem going on where they lay off, not lay off, but they furlough a bunch of government employees. That can kind of create problems sometimes. But we look for diversity in employment industries. Commute to work isn't so much of a big deal. And then we also look at occupations in the area. Is it primarily farmers, foresters, and fisheries? That's great. We need them, but do they make a lot of money? Can they really support and afford the rents there? We look for consistency ish. Like these are fairly well balanced. Although I would say factory workers and laborers are a bit uh, housed, and maybe sales and service workers as being the leaders in that space because those are industries that they're higher paying jobs, generally more stable, things like that. Languages spoken, we use that sometimes, like in a lot of times in the deals we look at in Texas. Naturally, Spanish is going to be a very common language outside of English, and that just kind of tells us that the staff that we need to hire, we need to make sure that they're bilingual. Now let's get into income here. So income is really important, right? We need to make sure that the people living in the apartment complex have the means to pay the rent, and we can use the neighborhood household median income as a barometer for what is the affordability in the area. We really like to have deals that are $40,000 or more in the neighborhood. This one's at 26, so really, really low. This is a really kind of economically depressed area there. Um, so this is a red flag for us, right? Like this is like reason to disqualify the deal, and I think it's one of the reasons why we killed this project was that the income was super low. We also found that the vacancy rate is I know I said it looked like the vacancy was super high, but it's actually at 19.3%, which is really high. We like, let me describe this a different way. We don't really care what the vacancy is going in, right? But because if there's less units that are occupied, that means we can go in and make the renovations on a whole bunch of units up front without really impacting the business. Instead of having a place that's 100% occupied and needing to go in and wait for those leases to expire, and then it just kind of drags out the whole overall process. So we actually like the fact that the vacancy rate is sort of high. Let's see what else. The neighborhood income rate is lower than 97% of the rest of the US. So that's a big problem. We don't really want that. Talked about the home value, $81,000. The house income is 26,000, which is super low. And the crime, we didn't get to crime. Let's jump into crime real quick. Yeah. So crime, as you sort of really saw, This one is ranked at 19 out of 100. I will say that when looking at many of these deals, most apartment deals have relatively high crime. I rarely see this crime index over 15, 20%. And even if they're at that low number, it doesn't mean that, people are generally getting shot all the time. It's very rare to see this index at, 80, 90 or 100%, at least for the market that we look at apartments at. And then schools is the next thing that we look at. Schools are really bad here. These are 1 out of 10 rankings, and it's ranked at number 2. So, we like to have properties that can accommodate families, right? It's sort of the bread and butter of what we do and how we operate our properties. We want people to have a sense of belonging. We want to have people have a sense of community, and so we want to really buy properties that have pretty decent to great school districts, so that we can welcome those families in there because they'll stay longer. Really, that's really what the bottom line here is. And so, less turnover that we have in a property, the more stability we have for the income, and also the less loss of money we have for our investors. So the schools are really bad here. That was another strike against it. And I believe those were the kind of the big thing. The other problem was the population's decreasing. So, population growth so I would say, ranking job growth, population growth are kind of the 2 biggest things. And in this particular area, the population's decreasing. So the market for renters is actually getting smaller and smaller. Not a trend that is likely to reverse anytime soon. And it's just like a way of mitigating risk. Like, if we know that the market's getting smaller, that's only going to create problems for us later on down the road. It'll increase a vacancy, which means that we don't have enough money coming in, and that kind of creates a bad example to do a deal like that. So for all of these reasons, and maybe a couple of more, are the reasons why we passed on this particular project in Montgomery, Alabama. I hope you found that useful. Thank you so much for watching. If you want to know more about If you haven't already joined our investor club, I highly recommend that you consider it and go ahead and schedule some time with me on the calendar on our website. If you haven't already joined our investor club for tech salespeople, I encourage you to go to our website, www.significantlc.com, and go ahead and find a link to book time with me to talk about your investment goals and to see if you're a right fit for our investor club. Thanks so much. See you soon.